A sector rotation can offer clues about where the market is headed. Now, big money shifts from one part of the market to another, like moving out of tech growth stocks into value-oriented industrials, or from large caps into the Dow to small caps in the Russell 2000. Now, capital is now flowing into mid caps as well as rate-sensitive cyclical sectors. Well, joining me ahead of the long holiday weekend here in the U.S. is Eddie Ghabour, the co-founder and CEO of Key Advisors Wealth Management. Happy Friday, Eddie. Thank you so much for joining me. So we are heading into a holiday weekend, and so far this month and this year, we have seen new record highs for the Dow, S&P 500, and precious metals. So tell us about what we're seeing in terms of the markets and where you see the winners and losers.
Well, I think the early indications on what this market is telling us is that this economy is going to be very strong in this first quarter and first half of 2026. This is why you're seeing the economically sensitive areas really outperform the tech trade. And that says a lot because the last 3 years, it's been a very concentrated market. And things are really broadening out, and the economically sensitive areas are outperforming the NASDAQ by a very wide margin. So this is extremely bullish because the broader the market goes, the healthier it is, and frankly, the easier it is for investors because now you can have a more diversified portfolio and not have to be so aggressively positioned in technology.
Yeah, and I think it's important to point out that broadening of the rally that we're seeing across markets. As we head into today's session, we are looking at key levels for the major equity averages. But you mentioned the economy, and there's a lot of anticipation heading into 2026. So you talk about record highs in housing, small caps, industrials, and regional banks as a sign of the economy booming this year. So give us an overview of your outlook.
So we think coming into 2026, there was too much pessimism in regards to the growth trajectory of the market. All the focus has been on the Fed and the AI trade. And so the bar was set really low for those areas you just mentioned that we've been favoring and rotating into. And so when you go into earnings season, we think they're going to surprise to the upside because when you look at the economy, you got a lot of productivity growth because of AI. That's going to start to increase profits for corporations in earnings season. And those areas that are small companies and economically sensitive will benefit the most. When you look at the AI side, the bar is set so high that I don't know how much they can surprise to the upside from an earnings standpoint. So we always say that the market is forward looking in what it's telling you. And it's telling you that productivity and profits and things that are tied to the economy are going to do really, really well.
Yeah, so Eddie, how should investors be thinking about diversifying beyond tech to capitalize on this shift that we're seeing in the markets right now?
So when you look at the dynamics, if you're going to have a growing economy that's going to accelerate, and you have inflation that looks like the worst is behind us for now, and a Fed that's going to be very dovish, and an administration that is doubling down on housing, we have home builder ETF for clients. We have small caps. That's one of our favorite areas. That's been left for dead since 2021, frankly. And then industrials, as you mentioned, with financials. And financials, if you're worried about the credit card side, we would go towards regional banks. We think those have less exposure to the risk of interest rates coming down to 10% cap on credit cards. So rotating out of some of the software names and areas that have been very weak and rotating into what could potentially be the winner for 2026, in our opinion, is the best way to broaden out a portfolio. And you can diversify yourself more as well, too. And lastly, gold. We think gold is going to continue to do well. It's a great way to diversify strategy so that way the defensive part of a portfolio is not just focused in bonds, which can struggle in this type of environment.
Yeah, and finally, before I let you go, you mentioned regional banks, and earnings season has officially kicked off this week. We've been hearing from the big banks, but when it comes to regionals, what is your outlook and what does it mean for investors out there and why?
So when we look at small caps showing strength, a lot of small businesses, they bank and get loans from regional banks. And with the focus of our focus for 26 is seeing accelerated growth. So we think the ones that benefit the most to the upside are your smaller companies. So that also falls in line with the financials. So we think this is a really good setup for regionals. We're going to start to see loans and start to increase the amount of loans that these banks are going to be giving. I think you're going to see the regulatory environment loosen up as well too. So the regionals actually benefit more in that type of environment than the large banks, in our opinion.
And very quickly, before I let you go, when it comes to the Federal Reserve, what is your rate outlook? How many cuts are you expecting this year?
I think the market's going to price in 3 cuts. That might sound like a lot heading into where we are now, but I think this quarter you're going to start to see inflation decelerate even more, and that's not really priced in. So we saw core inflation come under expectations this week, which is a real positive. So we do think at some point in time this market's going to price in 3 rate cuts due to that dynamic, which again is another bullish catalyst.
Okay, Eddie, we will have to leave it there, but thank you so much for joining me. And as always, thank you so much for sharing all of your insights and analysis.
Thanks for having me.